Good morning, students. Today we'll see the topic ratio analysis. So, here in this ratio analysis, we'll see the introduction part, meaning of accounting ratios, meaning and definition of ratio analysis, objectives, classification, computation of ratios, their advantages and limitations. So, here just to recollect, this has a connection with the previous chapter, that is the eighth chapter, financial statement analysis. Why I say so is even here we'll be analyzing the financial statement, but using a different tool called ratio analysis, right? So here, moving on, let me give you the introduction part of ratio analysis. So here, introduction, the financial status, that is whenever any analysis of or the performance is being analyzed using the financial analysis or financial statements, then we normally call it as financial statement analysis. So we already have seen certain tools while calculating the financial statement or while analyzing the financial statements. So various tools which we saw in the previous chapter is the comparative statement, common size statement, trend analysis, and also we read about cash flow and funds flow statements. And here we will be dealing with the ratio analysis, and this is also an important tool which is used for analyzing the financial statements. There are various ratios or various forms of ratios in which these statements are being analyzed. So, next topic, meaning of accounting ratio. So, what is ratio? It is nothing but a relation or a mathematical expression of relationship between two related or interdependent items. Okay. For example, if you want to take up like your own marks, okay, we normally say it in the form of percentage. That is also a kind of a ratio wherein will express that in the form of the percentages. Like again, maybe if you have done sums, say in a week I'm giving you say 10 sums, you might have done 10 sums in a day, you might have done 8 sums in a day. So if I ask how many sums you do approximately in a day, when you take up ratio, when you have to take up ratio, you'll say 10 is to 8, which is nothing but again 5 is to 4. We'll simplify it and write it in the form of pure. We call it pure. The expression is called pure. And in times, so in times means, for example, let's take, you would have got 25 marks when you wrote your quarterly exam, and when it comes your half yearly, if you say get 75 marks, and I ask how many times it has been increased, so you have to say like, you will have to calculate it in the form of times, which is 75 divided by 25, so 3 times your marks have increased. Okay, so that is the expression in the form of time. So meaning of accounting ratio, so ratio is nothing but it is a mathematical expression of relationship between two related or interdependent items. So it can be normally in the form of numerical or quantitative relation. So it is actually divided or calculated by dividing one item to the other related item. And it can be, when we do it, these ratios are calculated if it is based on the accounting information, then we call it as accounting ratios. As I said, these ratios can be expressed in the form of pure, percentage or times. Meaning and definition of ratio analysis. So here, meaning, again, ratio analysis, it is a tool wherein which helps us to analyze the financial statement. As we saw in the previous chapter, financial statement is nothing but your income statement, manufacturing account, and balance sheet. So you're going to analyze your financial statement, but here the tool which we are going to use is ratio analysis. Okay, and you have a definition, a very simple definition here, that is, according to Mears, ratio analysis is a study of relationship among various factors in a business. Okay, this is the simplified or very simple definition of ratio analysis. And moving on to the objectives of ratio analysis. So here there are certain whys. What is why, or where the need of ratio analysis occurs. Okay, so first is, it shows all the accounting figures in a simplified manner, because accounting, you all might know, in lakhs, sometimes in crores also you get the values, right? So in big organization, large organizations, they get their uh, finance, or they get their values, figures in thousands, lakhs, crores. So instead of telling it in crores and lakhs, they will simplify it in the form of ratio. And it helps. It is, since we know that it is a tool of ratio analysis. It is a tool of analyzing the financial statements. Again, it helps us in facilitating the statement or financial statement analysis. Then the operational efficiency. So basically, operational efficiency, we talk about the profit and loss, how it has been achieved, whether sales has increased, or just because the increase in the the MRP, or the maximum retail price, the sale has I mean the profit has increased. So they will actually verify each and every account, they will actually relate each and every account, and come out with the analysis. Then it also helps in the budgeting and forecasting. So as we all know, budgeting is nothing but, it is just an estimate which helps to take the decision for future. Okay, and the last one is to facilitate intra-firm and inter-firm comparison of performance, which is department wise. When we do, we call it as intra-firm. Inter-firm means the same type of a company wherein the performance can be compared. Okay, the next part is classification of ratios. Here, ratios are basically classified as two categories. One is the traditional classification, the other one is functional classification. Today I'm going to explain you about traditional classification alone. So now, traditional classification is nothing but where the financial statements are analyzed, from which the ratios are calculated. So we must know what is financial statement. Financial statement is where manufacturing account, income statement, and balance sheet is involved. Okay, so under this classification, that is under the traditional classification, the ratios are classified into three categories. One is balance sheet ratio, second income statement ratio, and the third one is inter statement ratios. So here the name itself says balance sheet ratio, which means when two accounts are being compared. Okay, in that case, both the account would have appeared in the balance sheet. For example, if you are comparing your current assets and the fixed assets, both account appear only in the balance sheet, right? So in that case, we call it as balance sheet ratio. So if both items in a ratio are from balance sheet, it is classified as balance sheet ratio. Second one is income statement ratio. So what is income statement? This income statement talks about your trading and profit and loss account. So when two accounts are compared within the balance sheet, within the profit and loss account, or within the trading account, then we call it as income statement ratio. So if two items in a ratio are from this income statement, it is classified as income statement ratio. Then interstatement ratio. So interstatement is nothing but one account is in the income statement, the other account is in the balance sheet, then we call it as interstatement ratio. So if the ratio is computed with one item from income statement, another item from the balance sheet, it is called as interstatement ratio. Okay, so you have an example here, that is balance sheet ratios. You have your current ratio, quick ratio, proprietary ratio, and debt equity ratio. Income statement ratios are gross profit ratio, operating cost ratio, operating profit ratio, net profit ratio. And the last one is interstatement firms ratios. So interstatement ratios, you have return on investments, trade receivables turnover ratio, trade payables turnover ratio, and fixed assets turnover ratio. So with this, I'll wind up today's session. So you have to write 1 mark and 2 mark answers from this chapter, again for which I have attached you the PDF of both 1 mark, 2 marks also. Thank you, children.